In this video, I want to talk about something we discuss in class often, and I just want to make sure that this is one of those important takeaways that you leave my class with, and it deals with the value of a transaction. So I've set up three examples here, and the main concept is that when you decide what the value of a transaction is, it's either based on what you give or what you receive. So in the rule that should guide you is you choose the one that is most evident, the one that has most support in terms of being able to provide evidence. So here's an example, and we really don't think about it when we deal with transactions as the following. Here's business one and business two. Business one gives $500 of cash or a promise to cash in the sense of an accounts receivable, and in return gets a machine from business two. So the opposite is true for business two. They get the cash or the promise to cash, and then they give the machine to the other business. Okay, we've never really given thought in terms of what the value of the transaction is here, but the value is clearly the cash. And it goes without saying that cash in itself is the one that's best supported. It is the fair market value. $500 in cash is worth $500 in cash. So we never really think about it in terms of that value of a transaction. So here, for business one, let me align this real quick. So for business one, their recognition in the books is for $500. In other words, they'll go in there and do machine 500 and then credit, let me correct this, and then credit either cash or AP for 500. Okay, so in the books of business one, it's AP, but what are they giving? They are giving a receivable to business two. So business two will record accounts receivable or cash, if that's what they get, for $500. And we never give it thought, but that's just how it is. We chose the value of this transaction not based on the worth of the machine, which you could have gotten an appraisal of the machine if you wanted to, and that's further support, but you don't need to, because the one that is most evident here is the exchange of cash or the promise to cash. So that's where the value of the transaction exists as well, even though we don't discuss it as such. Now, here's another scenario. Business one issues equity, in other words, issues stock to business two in return for a machine. Okay? So instead of giving cash or a promise to cash, they're giving equity. So which one is more evident? Which one is better supported? The value of the machine or the value of the stock? And that depends. It depends on whether this stock is publicly traded or not. Excuse me. So if for some reason that stock is publicly traded, then that's a good metric of fair market value. And I would argue that we would value the worth of this exchange based on the worth of that stock. If on the other hand, this is a private company and you're issuing equity in that company, but the stock is not necessarily traded in a public exchange, then at that point, it might make more sense to value the transaction based on the worth of the machine. Maybe doing an appraisal of the machine or of the land or whatever it is that you are exchanging. So this one becomes a little bit less clear because it's not just cash as to what the worth of that transaction is. And once the worth of that transaction is determined, then the journal entry would just be the same as we did here, except for the correct value, whatever that may be. Okay? So keep that in mind. Whenever we're not dealing with cash, a decision has to be made as to what the value of that exchange is. Then we had scenarios that we saw where in the topic of non-monetary exchanges. And if you recall, we might be exchanging machine A for machine B. So business 1 gives their machine A to business 2, and in return they get machine B. Now, here I've created an example that says that business 1 gives a machine plus cash. So if I am business 1 and I am giving my machine A plus cash, it must mean that machine B is worth more. Machine B is worth more than machine A, right? Because I'm giving that machine, and on top of that, I'm throwing in some cash. So this is one of those scenarios where you have to determine as well what the value of the exchange is. And again, simple. You either base it on what you give or what you receive, whichever is most evident. So I know that the cash component is easy to value. So just for the heck of it, let's say this is $100 of cash. Okay. And then this person or this business receives $100 of cash. So then the next question is, what is machine A worth? So if machine A is worth, just for the heck of it, say $400, I am giving a machine that's worth $400, and on top of that, I'm throwing in $100. So I am giving in total $500. If I decide to value the transaction as such, then I value machine B at $500 because I'm giving $500 worth of stuff, and then I am getting B. So it must mean that machine B is worth $500. And the same analysis can be done on this end. Maybe business 2 understands what the worth of machine B is. So when they give machine B, just to keep it symmetrical here, they think that B is worth $500. Okay, this is what business 2 believes. So then they value their exchange at $500. So it must be that this machine A is worth $400 plus the $100. Now, this assumes that there's symmetry here, and there doesn't have to be. In other words, I can perceive that machine A, if I'm business 1, I can perceive that machine A is worth $400 plus 100, meaning that for business 1, the transaction or the value of the exchange is $500. But I could also be in a different scenario if I'm in business 2. I might believe that my machine is worth $600. Okay? And if that's the case, then the value of the exchange for this company is $600, while the value of the exchange for this company is $500. And that's okay, because it's based on their best estimate of what they think the worth of the exchange is. Okay? Now, in general, if you value the transaction at 500, let's say, then for business 1, you have machine B, which goes in the books at 500, just to keep everything simple. And then you have machine A that you give, and you determine that was 400 because if the worth of the exchange is 500 and you're giving cash of 100, then that's what it is. Okay? That's the journal entry we are assuming. Because a lot of times we assume that what we determine the value of an exchange to be is also what we determine the recognition in the accounting. And that makes a lot of sense. And then for business 2, they are receiving cash. And in this case, I'm going to assume symmetrical treatment. They both think that the worth of the exchange is 500. And they receive machine A, so that's 400. Oops, my apologies. And then they give machine B. So that goes out of the books for 500. There you go. So that's how we would record these transactions. And notice how the way I recorded these transactions was always the same as what I determined the value of the exchange to be. And that's normally going to be the case. But then sometimes you have some exceptions. And if you remember, in the non-monetary exchange examples, there was a scenario dealing with no commercial substance, and then if that's the case, if there's a gain, then the gain might be limited in terms of what amount you can recognize. And I'm not going to go into details here, but assume that we had a scenario that, as such, where I have a gain that I'm not allowed to recognize because the transaction has no commercial substance. If you are in one of those scenarios, and I'm not going to illustrate fully here, but if you're in one of those scenarios, you might have an exchange. Well, here, let's go ahead and bring this one over here. Maybe I can add a little bit to it. I give a machine A, and then I give cash, right? And then, hopefully this works out. Machine A has a gain, a built-in gain of $5, okay? And again, I'm not going into full details. I just want to illustrate the big picture. So if I'm missing a couple of links, that's okay. All right, so even though the potential gain might be $5, for whatever reason, that gain recognition might be limited, okay? So the gain recognition limited to $3. What that means is, even though the value of the exchange might still be $500, if I am not allowed to recognize part of the gain, in this case, not allowed to recognize $2, it means that the amount I would record would be minus $2. In other words, 500 minus $2 would be the amount or the value that I recognize. And I know that sounds very weird, but recall that when you are not allowed to recognize a gain, it reduces the basis of the new asset. So if you go back and review your non-monetary exchanges, you can look into that. And the purpose of this is not to get complicated with non-monetary exchanges, okay? Let's just get that straight. The purpose of this is, even though we have a value of an exchange that perhaps can be viewed as $500, as we did right here, if we have a scenario that is limited because of the accounting rules, like in an example, non-monetary exchanges, and I'm not allowed to recognize part of that gain as an example, then even though the value of the exchange is X amount, what I recognize in the books might not be X, might be Y amount. And that's the big picture. So in general, whatever you determine the value of the exchange to be is what is recognized in the accounting. There are some exceptions in our accounting world where that's not the case. And this concludes the video on the value of a transaction.